Okay, so let's go over an example of how to prepare the cash payments budget. So here we can see the purchasing and the payment activity for January and February. And we know the direct materials purchases are purchased on account and they pay 30% in the month of purchase. The balance is due in the month following the purchase. All other items are paid in the month incurred. Manufacturing overhead includes $13,000 of depreciation. We know that's non-cash. Selling and administrative expenses include $5,000 of depreciation expense and $1,500 of bad debt expense. So this is your operating expense budget. So now we need to figure out what cash payments we're going to make in February. So first we have to look at our cash payments for direct materials. Okay, and so in February, we will pay for 30% of February. But then we will pay for 70% of last month, January. Right? Because that's what we're told. You pay 30% in the month of purchase. The balance is due in the month following the purchase. So in January, we would have paid 30%. The other 70% gets paid in February. So we're going to pay 70% of January. And we'll pay 30% of February. So our total paid is $117,000 for direct materials. Then our cash payments for direct labor, we will pay that in the month incurred. So we'll pay $115,000 for direct labor. Our cash payments for manufacturing overhead, right? And this amount would have been the bottom line on the direct labor budget. This is the bottom line on the manufacturing overhead budget. However, it includes $13,000 of depreciation. We don't have to pay any cash for depreciation, right? Because we paid for the equipment when we bought it, and depreciation is just spreading the cost over the time you use the plant and equipment to generate revenue for your business. So we're going to subtract the $13,000 to get the cash payment. And then we've got our cash payments for operating expenses. And so this is the bottom line on the operating expense budget, but that includes $5,000 of depreciation, which is a non-cash item, and it also includes $1,500 of bad debts expense. That's not a payment of cash either. So then we can just total up. And that's going to be our total cash payments. Okay, so now that we know our cash collections and our cash payments, we can do our combined cash budget. So this is where we can plan. We can see what our cash balance is going to be every period, see if we need to borrow from our line of credit, if we're in a slow period, see if we have excess cash that we may want to invest and get a higher rate of return than just sitting it in our operating checking account. All right. So here's the format for our combined cash budget. We start with our beginning cash balance. We add our cash collections from our cash collections budget, and that gives us our total cash available. Then we subtract our cash payments from our cash payments budget, and that gives us our ending cash balance before financing. So see, we have a negative amount. So we're going to need to borrow. Okay. And so we don't want to borrow just enough to have zero as our ending cash balance. Typically, companies will set a required minimum cash amount that they want to have. So you will borrow to make sure you're at least at the minimum cash amount. Then that ending cash balance becomes the next month's beginning cash balance. Okay. And again, we add the cash collections from the cash collections budget subtract the cash payments from the cash payments budget, we get our ending cash balance before financing. And we can see here that they've got way more than maybe $15,000 was their required minimum. They've got way more, so they can pay off the line of credit from last month. So we'll subtract the $20,000, but then we also have to pay 1 month of interest on what we borrowed last month. And so we subtract that as well to get our new ending cash balance, which again becomes the beginning cash balance for the next period. Okay, so here we are. We're going to prepare the combined cash budget for January and February. So our starting point is going to be our beginning cash balance. And we're told that it's $30,000 for January. Then we're going to add to it our cash collections. So we would go to the cash collections budget. And we can see our cash collections is $230,000. So that's what we'll list on the January combined cash budget. So our total cash available is the beginning cash balance plus the cash collections. Then we need to subtract our cash payments. Okay. And you would go to the cash payments budget. We don't have a cash payments budget for this example. So here they're telling us this is the cash payments from the cash payments budget. So we would subtract the $262,000 to get our ending cash balance before financing. So when we subtract the total cash available minus the cash payments, we get negative $2,000. So we need to borrow from our line of credit. We have a required minimum cash balance of $25,000, so that means we need to borrow $27,000 in order to reach that required minimum balance. So our ending cash balance before financing plus our new borrowing will get us to our ending cash balance of $25,000. So there we've met our required minimum. So our ending cash balance for January becomes our beginning cash balance for February. We'll go to the cash collections budget to get the cash collections for February. So we go to our cash collections budget, we can see it's $412,275. And so we can combine to get our total cash available. And so our cash payments would come from the cash payments budget. So in February, our cash payments budget showed $346,300. So our ending cash balance before financing is $90,976. It's well above our required minimum, right, of $25,000. So that means we can pay off our line of credit. But then we have to pay 1 month of interest. So 6% is the annual rate. So we have to go back to financial accounting. It's our principal times the rate, 6%, times the time, and we're paying for 1 out of 12. So we have to pay $135 in interest. So our ending cash balance then would be, the $90,976 minus the $27,000 to pay off our line of credit, minus the $135 in interest we have to pay on the line of credit. So, that's not what I wanted. So that leaves us with our Ending cash balance, 63,841. And then that would become our beginning cash balance for March. So then, after we prepare all of these financial budgets, we can do our budgeted balance sheet. So cash would come from the cash budget. Accounts receivable, we could get from the cash receipts budget. Inventory from the production budget. And then any prepaid property tax and insurance. Our property, plant, and equipment, the beginning balance in those accounts, plus any amounts from the capital expenditures budget. We could get our accounts payable based on the cash payments budget, stockholders' equity, the beginning balance, and then we'd add the net income from the budgeted income statement. So this is what our budgeted balance sheet looks like. It looks like just a regular balance sheet, right? But we would have pulled these numbers from our supporting budgets in the master budget. And so this is all of these budgets put together with the budgeted financial statements. These would be our master budget.